Today, we're going to dive deep into the latest portfolio moves from some of the most interesting super investors tracked by Dataroma for Q2 2025. I'll break down their strategies, the key trades they made, and give my own thoughts, including where I agree and where I completely disagree. And at the end, I'll talk about an investor who's been a huge influence on my investing style, someone I consider my mentor, and walk through his portfolio as well, because it reflects a lot of my own philosophy. So, let's get started. Valley Forge Capital, managed by Dev Kasaria. He is honestly one of my favorite investors. He runs a very concentrated portfolio, mostly in high-quality, asset-light businesses that dominate their industries. His two favorite hunting grounds are credit rating agencies like S&P Global and Moody's, and top-tier tech names like Intuit, Visa, and MasterCard. These are companies with deep moats, recurring revenues, and high returns on capital. They can compound wealth for decades. But the trade-off is that his portfolio isn't very diversified. If one of those few big positions takes a hit, it can drag down performance in the short term. In Q2, his only significant move was trimming Intuit by about 11.45%. To me, that's probably just profit-taking after strong gains. Nothing to do with a loss of conviction. The rest of his portfolio was untouched, which is classic Kasaria. Buy the best businesses, hold them for years, and let compounding do the work. That's a style I respect a lot. Michael Burry needs no introduction, famous for calling the housing crash in The Big Short. But what's interesting is that his current style is almost the opposite of Kasaria's. Burry trades actively. His positions change quarter to quarter, and without seeing his entire hedge book, it's hard to know the full picture. In Q2, he made some big diverse buys. Lululemon, about 21% of the portfolio. Bruker, 18%. Regeneron, 14%. Mercado Libre, almost 14%. United Health, 11%. He also cut Estée Lauder by 25%. Now, these are all strong companies in their own right, but the variety is striking, from high-end apparel to biotech to e-commerce to healthcare. That's Burry. No single theme, just conviction in undervaluation. The challenge with Burry's portfolio is that if you try to copy him, you might be out of the stock before you even get in, because his holding periods can be short. His moves are worth watching for ideas, but you need your own reasoning to actually hold them long term. Dorsey Asset Management. Pat Dorsey made his name at Morningstar, where he popularized the concept of economic moats. His fund sticks to that. Companies with strong competitive advantages that can fend off rivals for years. In Q2, the headline move was a big buy of Enovis, a medical technology company. I'll be honest, I'm not entirely convinced by this pick. It's now one of his top positions, but to me, it doesn't have the same undeniable moat as his best holdings. On the flip side, he made some moves I do like. Added heavily to ASML, a true monopoly in lithography machines. Increased Danaher and AirCap, both high-quality businesses. He also exited PayPal and Sprout Social completely, which is interesting because both have strong positions in their niches. Overall, I respect his philosophy, but I'm not sure his Q2 trades were his strongest. Chris Hone, TCI Fund Management. Chris Hone runs one of the most concentrated, high-quality portfolios in the hedge fund world. He's an activist at times, but mostly he's just holding a list of dominant global companies. In Q2, he added significantly to Visa and S&P Global, small increases to Microsoft and Moody's, and reduced his stakes in Alphabet and both Canadian railroads. I completely agree with moving capital from railroads to SPGI and Visa. Both are asset-light, recurring revenue businesses that can grow faster than the economy. What I don't agree with is trimming Google, especially when it was trading at attractive valuations earlier this year. Still, Hone's portfolio is a masterclass in quality growth investing. Josh Terasoff, Greenlee Lane Capital. Josh Terasoff doesn't have the name recognition of a Burry or a Hone, but his portfolio is one I really like. His largest position is Amazon, just like mine, which already says a lot about our shared philosophy. In Q2, he made an interesting shift. Sold out of Brookfield Corp and bought heavily into Brookfield Asset Management. Here's the difference. BN owns the real assets, infrastructure, real estate, renewable energy, plus a controlling stake in BAM. BM is the fee-based asset management business, much lighter in capital requirements and much more predictable. By moving from BN to BAM, Terasoff is swapping some long-term asset appreciation for steadier, higher-margin income streams. That's a move I think makes a lot of sense if you want more predictable returns. He also added massively to Burford Capital, which finances litigation cases, a more niche business, but one with asymmetric upside when cases are won. Terry Smith, Fundsmith. Terry Smith is known for one of the simplest and most effective investment philosophies. Buy good companies, don't overpay, and do nothing. For years, this strategy worked wonders, but lately Fundsmith's performance has lagged the market. In Q2, most of his moves were micro adjustments, trimming Meta, Microsoft, Visa, Philip Morris, Stryker, and others. He added to Intuit, Zoetis, and started positions in Vertiv and Manhattan Associates. The core remains strong: Microsoft, Meta, Visa, Procter & Gamble. But recent results show that even the best strategies can hit rough patches. I still respect his discipline, but I feel like the edge has been dulled a bit in the last year or two. Now, I want to talk about someone who isn't technically a super investor, but who has been a big influence on my own investing. Joseph Carlson, whose approach mirrors my philosophy in many ways. Here's his portfolio. Heavy in financial data and payments, S&P Global 14%, MasterCard at Moody's 6.5%, all high-quality, asset-light compounding machines. Strong tech exposure, ASML 5.4%, Microsoft 8.2%, Intuit 8.7%, Salesforce 7.6%, Apple small at 0.3%. Consumer dominance, Costco 11% and Booking Holdings 8.2%, both leaders in their categories. Even a high-quality restaurant chain in Texas Roadhouse, 9.7%, which has quietly been one of the best-performing casual dining companies in the U.S. This portfolio is concentrated in world-class businesses with predictable earnings, strong moats, and high returns on capital. It's the perfect example of quality over quantity. No chasing cheap valuations for the sake of it, no speculative plays, just the best businesses in the world, held for the long term. That's why I consider him my master in investing. His discipline, his focus on high-quality compounding machines, and his willingness to hold them through cycles. That's exactly how I want to invest. He also has another, more tech-focused portfolio, which we'll talk in another video. Looking across all these investors, you see a common theme. It's not about finding the most exciting stock for the next 6 months. It's about owning companies that will still be dominating 10 years from now. Some do it with a more concentrated approach, like Kasaria or Joseph. Others, like Burry, move in and out rapidly. And then there are steady compounders like Hone, Terasoff, and Terry Smith, each with their own flavor. Even when I disagree with some moves, like trimming Google at the wrong time or making questionable picks like Innovis, I still respect the discipline and framework behind each portfolio. The lesson is simple. Find a philosophy that works for you, study the best, but make your own decisions, because even the greatest investors in the world don't agree with each other all the time, and they don't have to. Thanks for watching. See you in the next one.